Our price assessments are used as the underlying mechanism to settle battery raw material derivatives on the world's largest commodity exchanges. The CME Group, largest derivatives exchange in the world, ICE, owner of the New York Stock Exchange and largest energy and commodities exchange, the London Metal Exchange, and SGX all use Fastmarkets prices to settle their futures contracts. Now, this is extremely important because a fundamental principle of price risk management and futures markets is the so-called convergence principle, which states that at expiration, futures prices need to converge to the spot price. So exchanges launch products that reflect the physical market. Hence, the strengths of our benchmarks are also reflected in the growth of the futures markets. Derivative contracts are essentially tools that enable businesses to mitigate price risk. Businesses transact using floating prices that can be unpriced at the time of entering agreements. The underlying benchmarks used as the floating price in these contracts create price risk that can be efficiently managed by matching the exposures of the physical contracts to derivatives positions traded on commodity exchanges. Additionally, cash-settled futures, ones that settle against a price benchmark, do not create physical delivery exposure, which is important given the nature of the battery raw materials products and their supply chains. As we have seen in other markets that are more mature, such as iron ore, cash-settled futures have shown to be efficient price risk management and investment instruments. The energy transition is the largest shift in commodity markets we have seen in our lifetimes. This requires enormous amounts of investment to build out these emerging supply chains. It also creates uncertainty around supply and demand dynamics, policy measures, global trade flows, in addition to the emergence of market-based pricing mechanisms in some of these markets, such as lithium. This creates uncertainty that can be reflected in price fluctuations. Market participants need tools to be able to effectively manage their price risk in order to protect their margins, manage inventory, and grow their physical operations. Lenders typically want to strip out commodity price risk when providing project finance to support the build-out of these supply chains. It's critical there is a liquid futures market that enables risk transfer.